America's most powerful bank just made a move that should have made headlines everywhere. But it didn't. No press conference, no emergency announcement. Just a quiet repositioning of $4.56 trillion in assets over the last 90 days. To put that number in perspective, that's larger than the entire economy of Germany. Larger than the GDP of 150 countries combined. And when JPMorgan moves like this, history tells us something breaks within a few years. This is the same bank that swooped in to buy Bear Stearns when it collapsed in March 2008. The same bank that absorbed Washington Mutual 6 months later in the largest bank failure in American history. The same bank that grabbed First Republic in 2023 when regional banks started falling like dominoes. JPMorgan doesn't react to crises. JPMorgan sees them coming and positions accordingly. And right now they just positioned, if you have a savings account, this affects you. If you have a retirement plan, this affects you. If you're just trying to make it paycheck to paycheck, this affects you most of all. Because what's happening right now is not about Wall Street traders or hedge fund managers playing with numbers on a screen. This is about the invisible foundation underneath your financial life. And that foundation just shifted in ways that most people won't understand until their credit application gets denied, their mortgage rate spikes, or their job disappears for reasons nobody can quite explain. The question isn't whether you'll be affected. The question is whether you'll see it coming before it hits. On January 13th, 2026, JPMorgan Chase reported its fourth quarter 2025 earnings. The headlines looked great. $46.8 billion in revenue, $13 billion in net income, record payments revenue of $5.1 billion, record asset and wealth management revenue of $6.5 billion. Sounds like a bank firing on all cylinders, right? But here's what the headlines didn't tell you. Buried in the details was a $2.2 billion credit reserve. Not for losses that already happened, for losses they expect are coming. That's $2.2 billion set aside for a single forward purchase commitment on the Apple credit card portfolio. When a bank that size suddenly reserves that much capital for future losses, they're not being cautious. They're seeing deterioration that hasn't shown up in the official numbers yet. And that's not all. Their advanced Basel III Common Equity Tier 1 capital ratio dropped 90 basis points from this one move alone. That's nearly a full percentage point of their capital buffer gone in a single quarter. The standardized ratio fell 30 basis points to 14.5%. Now let me show you what the balance sheet actually reveals. Total assets as of September 30th, 2025 stood at $4.56 trillion, up 8.32% from the year before. Deposits hit $2.57 trillion. Loans came in around $1.5 trillion. That loan to deposit ratio tells you everything. They're holding significantly more in deposits than they're lending out. They've got massive liquidity sitting on the sidelines. Cash and marketable securities totaling over $1.4 trillion in high-quality liquid assets. That's not normal lending behavior. Banks make money by lending. They want to put deposits to work. What you're looking at is fortress balance sheet behavior, the kind of balance sheet you build when you expect trouble ahead. During the earnings call, CFO Jeremy Barnum said they expect card net charge-offs to hit approximately 3.4% in 2026. That's losses on credit card loans. They're projecting elevated losses before those losses even materialize. Meanwhile, their 2026 expense guidance came in at $105 billion, up from $96 billion in 2025. They're spending more while simultaneously pulling back on lending. Jamie Dimon himself said during the call that they have 30 to 40 billion or more of excess capital. They're sitting on mountains of cash they could deploy. They could be lending aggressively. They could be chasing growth. Instead, they're building walls. And when the most sophisticated bank in the world chooses safety over profit, they're telling you something without saying it directly. JPMorgan isn't just any bank. They're the bank that regulators call when the system starts breaking. In March 2008, Bear Stearns was hemorrhaging cash. Their liquidity position dropped $16 billion in a single week. Trading partners refused to do business with them. On March 14th, Bear Stearns told the Federal Reserve they would not have enough money to open their doors the next day. Who stepped in? JPMorgan. They bought Bear Stearns for $10 a share. A year earlier, that stock traded at $133. 6 months later, Washington Mutual experienced a classic bank run. Panicked depositors withdrew $16.7 billion in just 9 days. The Office of Thrift Supervision seized the bank on September 25th, 2008. The largest bank failure in American history. Who was waiting? JPMorgan. They bought the banking operations for $1.9 billion. Fast forward to May 2023. First Republic Bank was collapsing. Deposits were fleeing. The FDIC stepped in, and once again, JPMorgan absorbed the wreckage. See the pattern? JPMorgan doesn't get destroyed by crises. JPMorgan gets bigger. Every single time the system breaks, they emerge more dominant, more systemically critical, more powerful than before. That's why their current positioning matters so much. Jamie Dimon has been warning anyone who will listen. In October 2025, he told Bloomberg that a recession could happen in 2026. His exact words, "I hope for the best, plan for the worst." You don't wish it, because certain people get hurt, but it could happen in 2026. During the January 2026 earnings call, he called current conditions treacherous. He warned about a cocktail of fiscal expansion, sticky inflation, and escalating geopolitical conflict. JPMorgan's own research now puts the probability of a 2026 recession at 35%. But here's what really caught my attention. Dimon used what he called the cockroach theory to describe what he's seeing in the credit markets. When several subprime and private credit lenders collapsed in late 2025, Dimon said, "When you see one cockroach, there are probably more." He's talking about the $3 trillion private credit market, the shadow banking system that operates outside traditional regulation. And he's saying it's starting to fracture under the weight of higher interest rates. This is a man who has been CEO of JPMorgan since 2006. He steered the bank through the 2008 crisis. He's seen what happens when credit markets seize up. And right now, he's building a fortress. To understand why JPMorgan is positioning this way, you need to understand the debt situation in America right now, because every layer of the economy is leveraged to levels we've never seen before. Start with the federal government. As of January 2026, the national debt stands at $38.4 trillion. Let me put that in terms that actually mean something. Over the past year, the debt grew by $2.25 trillion. That works out to $612 billion per day, $255 million per hour, $4.25 million per minute, $7,843 every single second. The debt increased by $71,884 for every second of the past year. In July 2025, Congress raised the debt ceiling by $5 trillion to $41.1 trillion. The Congressional Budget Office projects federal deficits will exceed $2 trillion annually for the next decade. But here's the part that should terrify you. Interest payments on that debt hit $1.2 trillion in fiscal year 2025. That's more than the entire defense budget, more than Medicare. The government is now spending over $1 trillion per year just to service the interest on money it already borrowed. In the first quarter of fiscal year 2026, October through December, interest expense hit $179 billion, up from $160 billion the same period a year earlier. The Congressional Budget Office projects interest payments will reach $1.6 trillion by 2034. At that point, interest alone will consume 1 out of every $4 collected in individual income taxes. Now look at consumers. Credit card debt in America hit $1.233 trillion in the third quarter of 2025, the highest level ever recorded. That's up from $770 billion in early 2021, a 60% increase in 4 years. The average credit card interest rate sits at 20.97% for all accounts. New cards are coming in even higher, around 23.79% on average. The 30-day delinquency rate dipped to 2.98% in the third quarter of 2025, which sounds like improvement until you realize it's still elevated compared to historical norms. The average since the Fed started tracking in 1991 is 3.70%. But here's what the averages don't tell you. Delinquency rates in the lowest income zip codes grew 63% from 2021 to early 2025. The stress is not distributed evenly. It's concentrated among the people least able to absorb it. JPMorgan sees this in real time. They process millions of transactions every single day. They see default patterns forming before those patterns show up in national statistics, and they're reserving capital accordingly. There's another crisis building that most people aren't paying attention to: commercial real estate. Office buildings across America are sitting empty. The national vacancy rate hovers between 14% and 20%, depending on which market you're looking at. In cities like San Francisco and Austin, vacancy rates are hitting 25-year highs. But vacancy is just the symptom. The real problem is the debt. In 2025 alone, $957 billion in commercial real estate loans matured. That's nearly triple the 20-year average of $350 billion per year. Another $539 billion comes due in 2026. Another $550 billion in 2027. That's over $2 trillion in commercial real estate debt that needs to be refinanced in a 3-year window. And here's the problem. These loans were originated when interest rates were near zero. Now property owners need to refinance at much higher rates on properties that are worth less than when they bought them, with vacancy rates that make the income numbers look terrible. The delinquency numbers are already ugly. Commercial mortgage-backed securities for office properties hit 11.7% delinquency in August 2025. That's not a typo. 11.7%. To put that in context, during the 2008 financial crisis, office CMBS delinquencies peaked at 10.7%. We've already blown past that. As recently as December 2022, office CMBS delinquency stood at just 1.6%. In less than 3 years, it's multiplied by 7. Multifamily properties aren't doing much better. CMBS delinquency rates for apartment buildings hit 6.9%, the highest since 2015. 2 years ago, that number was 1.8%. Here's why this matters for the banking system. Banks hold roughly 60% of all commercial real estate loans in America. That's nearly $3 trillion in exposure. And regional banks are especially vulnerable. The largest banks have about 50% of their risk capital tied up in commercial real estate. But smaller regional banks, some have a 150% to 228% of their total risk capital exposed to CRE. If these loans go bad, and they already are, regional banks start failing. We saw this movie in 2023 with Silicon Valley Bank and Signature Bank. The tactic right now is what the industry calls extend and pretend. Banks extend the maturity of troubled loans and pretend the borrowers will eventually be able to repay. It buys time. But it also postpones the reckoning. JPMorgan is watching this unfold. They're seeing the stress in their own commercial lending portfolio. And they increased their provision for credit losses to $466 billion in the fourth quarter of 2025. They're not pretending. What's happening now follows a pattern we've seen before. And if you understand that pattern, you'll understand why JPMorgan is positioning the way they are. Go back to 2006. The economy looked fine on the surface. Housing prices had peaked but hadn't crashed yet. Unemployment stayed low. GDP was growing. Banks reported strong earnings, but underneath, something was rotting. Citigroup's off-balance sheet assets reached $2.1 trillion in 2006. That actually exceeded their on-balance sheet assets of $1.8 trillion. Banks were moving risk into structures that didn't show up in normal disclosures. They were quietly preparing while publicly maintaining everything was fine. Research analyzing insider trading before the crisis found that bank executives who knew what was coming sold their own shares well before the collapse. They saw the deterioration in their own loan portfolios. They understood the risk exposure. And they positioned accordingly while telling investors nothing was wrong. Then came 2007. Credit rating agencies issued 8,000 downgrades on mortgage-backed securities that year, 8 times the number from 2006. The first 3 quarters of 2008 saw 40,000 downgrades, more than the cumulative total from 2000 through 2007 combined. The risk was obvious to anyone looking at the right data. But the public narrative stayed optimistic until Lehman Brothers filed the largest bankruptcy in American history on September 15, 2008. Here's the parallel to today. Record earnings on the surface, strong headlines, economy still growing. But underneath, JPMorgan is building fortress balance sheets. They're reserving billions for expected losses. They're holding excess capital instead of deploying it. They're watching delinquencies rise in credit cards, auto loans, and commercial real estate. The stress is visible to anyone looking at the right data, but the public narrative hasn't caught up yet. Jamie Dimon has lived this movie before. He was running JPMorgan in 2006. He saw what happened to banks that weren't prepared. He bought their corpses. And right now, he's making sure JPMorgan isn't one of the corpses. This doesn't mean banks close tomorrow. It doesn't mean you can't access your money. What it means is something more gradual, more insidious. Credit tightens slowly. You apply for a car loan, and the rate is higher than you expected. You try to refinance your mortgage and get denied. Your credit card limit doesn't increase when you ask for it. Your small business can't get the working capital loan it needs to expand. None of these feel like a crisis. Each one feels like an individual disappointment, a personal setback, something you did wrong. But collectively, across millions of people and businesses, tight credit strangles economic growth. Quietly, gradually, persistently, JPMorgan has 80 million customers. They serve 6 million small businesses. They're the largest credit card issuer in the United States. They process more payments than anyone. When they pull back even slightly, the ripple effects compound through every sector of the economy. Here's the mechanism. This isn't about JPMorgan failing. JPMorgan won't fail. They're the fortress. The too big to fail institution that only gets bigger after every crisis. The concern is what JPMorgan knows that forces them to position defensively. Because when the bank with the best information, the deepest government relationships, and the most sophisticated risk management in the world pulls back, they're telling you something without saying it. The pattern is predictable. Credit tightens. Growth slows, unemployment rises, loan defaults increase, banks tighten further. The cycle reinforces itself. But what makes this cycle different from normal economic cycles is where we're starting from. Government debt at $38.4 trillion. Corporate debt at record levels, consumer debt at record levels, student loans, auto loans, credit cards, mortgages. Everywhere you look, leverage is maxed out. When credit tightens in an already over-leveraged economy, the adjustment isn't gentle, not because of a single dramatic event, but because the margin for error disappeared years ago and nobody wanted to acknowledge it. To put that in context, during the 2008 financial crisis, office CMBS delinquencies peaked at 10.7%. We've already blown past that. As recently as December 2022, office CMBS delinquency stood at just 1.6%. In less than 3 years, it's multiplied by 7. Multifamily properties aren't doing much better. CMBS delinquency rates for apartment buildings hit 6.9%, the highest since 2015. 2 years ago, that number was 1.8%. Here's why this matters for the banking system. Banks hold roughly 60% of all commercial real estate loans in America. That's nearly $3 trillion in exposure. And regional banks are especially vulnerable. The largest banks have about 50% of their risk capital tied up in commercial real estate. But smaller regional banks, some have 150% to 28% of their total risk capital exposed to CRE. If these loans go bad, and they already are, regional banks start failing. We saw this movie in 2023 with Silicon Valley Bank and Signature Bank. The tactic right now is what the industry calls extend and pretend. Banks extend the maturity of troubled loans and pretend the borrowers will eventually be able to repay. It buys time, but it also postpones the reckoning. JPMorgan is watching this unfold. They're seeing the stress in their own commercial lending portfolio, and they increased their provision for credit losses to $466 billion in the fourth quarter of 2025. They're not pretending. Crises don't destroy everything equally. They concentrate wealth. They destroy the unprepared and reward the positioned. If lending tightens and credit becomes expensive, businesses that are already profitable and generating cash will survive. They don't need external financing to operate. They fund themselves. Businesses dependent on continuous credit availability to fund operations will fail. When the credit line disappears, so do they. Same thing for individuals. If you have stable income, low debt, and savings, you'll weather the storm. Tight credit doesn't hurt you because you don't need it. If you're living paycheck to paycheck with maxed credit cards, you're exposed. When credit tightens, the people who need it most can't get it. The people who don't need it get offered favorable terms. That's not moral judgment. That's mathematical reality. The system rewards strength and punishes weakness with brutal efficiency. Real assets that generate cash flow tend to perform better than pure financial assets during credit contractions. Rental properties that produce income, businesses that generate profits, infrastructure that provides essential services. These maintain value because they produce tangible economic output regardless of what credit markets do. Stocks depend on earnings, expectations, and valuation multiples. When credit tightens and growth slows, earnings disappoint. Multiples compress. Prices fall, not because companies disappear, but because future expectations collapse. JPMorgan's own stock might actually outperform during stress. They're the fortress, the bank everyone expects to survive. Money flows to safety during crises. JPMorgan is safety. But here's what matters for timing. This doesn't necessarily explode in 2026. The positioning we're seeing could be preparation for 2027 or 2028. Systemic crises do not arrive on schedule. They build slowly until something breaks. That something could be a bank failure, a corporate default wave, a sovereign debt crisis, a geopolitical shock. The trigger is unknowable, but the pressure is measurable. And JPMorgan is measuring pressure that warrants building walls. The challenge for normal people is this. You can't time the crisis. You can't sell everything and hide under your bed waiting for collapse. You have to live, pay bills, save for retirement, buy homes, raise families. The practical reality is you need to participate in the financial system, even when you understand the system has vulnerabilities. So what do you actually do? Reduce leverage where possible, pay down high interest debt. That credit card charging you 21% interest is bleeding you dry regardless of what happens in the broader economy. Build emergency reserves, 3 months of expenses, 6 months if you can manage it. Cash in a savings account isn't exciting, but it's what keeps you from becoming a forced seller when everything else is falling apart. Don't max out credit assuming it will always be available at current terms. The line of credit you have today might not be there next year. The mortgage you could qualify for today might be out of reach in 6 months. Not because you did anything wrong, but because underwriting standards tightened across the entire industry. For businesses, the same principles apply. If you need credit to operate, lock in terms now while credit is available. Don't assume you can refinance later at similar rates. Build cash reserves. Extend payment terms with suppliers if possible. Shorten collection times from customers. Businesses don't fail when they're unprofitable. Businesses fail when they run out of cash. And when credit tightens, cash becomes scarce fast. Suppliers demand faster payment. Customers delay paying you. Banks reduce lines of credit. The cash cycle compresses. Illiquid businesses fail, even if they're fundamentally profitable. That's what happened in 2008. Profitable companies couldn't get working capital and collapsed. Watch the real indicators. credit card default rates, commercial real estate delinquencies, corporate bankruptcy filings, bank loan loss provisions. These are the metrics that show stress in real time, not stock prices, not headlines, the actual credit quality data that banks see before anyone else. The next 12 to 24 months will reveal whether JPMorgan's defensive positioning was prudent or premature. If credit quality deteriorates the way they seem to expect, they positioned correctly. If conditions stabilize, maybe this was overcautious. But betting against JPMorgan's risk assessment is historically a losing trade. They've been right more often than wrong. And when they're wrong, they're still the last institution standing. There's a broader truth here that most people resist acknowledging. The financial system is fundamentally fragile in ways that normal economic analysis doesn't capture. Modern banking runs on confidence. Confidence that deposits are safe. Confidence that loans will be repaid. Confidence that counterparties will honor obligations. When confidence erodes, the system can unravel with shocking speed. We saw this in March 2023 when Silicon Valley Bank and Signature Bank collapsed within 48 hours. Not because of fraud, not because of obvious mismanagement, because depositors lost confidence and withdrew funds faster than the banks could raise liquidity. Confidence is binary. It exists or it doesn't. Once it's gone, restoring it takes years. JPMorgan's positioning suggests they're preparing for a period when confidence becomes scarce, when counterparties question each other's solvency, when depositors reconsider which institutions are actually safe, when borrowers find credit unavailable regardless of their creditworthiness. 2008 taught us this lesson. Credit markets froze not because every bank was insolvent, but because nobody knew which banks were insolvent, so everyone stopped lending to everyone. The interbank market died overnight. Only massive government intervention restarted it. We're not at that point now. But JPMorgan is building the balance sheet that survives that point if it arrives. $1.4 trillion in liquid assets, $2.5 trillion in deposits, conservative loan ratios, elevated capital reserves. This is fortress banking. You only build fortresses when you expect siege conditions. The warning is happening right now. It's just not on the evening news. It's not in the headlines. It's in the balance sheets. It's in the credit reserves. It's in the cautious words of a CEO who has survived every crisis for the past 2 decades. JPMorgan's balance sheet is telling you to pay attention. The question is whether you're listening. And the bigger question is whether you're positioned like JPMorgan, building your own fortress, or positioned like everyone they've acquired over the years. Because when the next crisis hits, and one always does, there are only 2 types of people. Those who saw it coming and prepared, and those who ask why nobody warned them. Consider this your warning.